When I was a kid growing up, I had one skill I had was I was able to take long lists of numbers and add them up pretty quickly. And so that's why all the employment things that you took in high school said I was going to be an accountant or an engineer, because they said whether you'd rather take a dog out for a walk or add up a large column of numbers. I said large column of numbers. Well, that may have been a great skill to have in the 19th century. But of course, with a $6 calculator, you can do it faster and more accurately than I could. When I showed up, not only was Harold Freeman on the admissions committee, he was the graduate student advisor. And I knew no economics, so I was kind of in line, especially when, remember, from what Paul told, every school turned me down except MIT gave me a full fellowship. So I was very grateful, and I was going to do whatever they told me. So I had done what the book told me, and I'd written economic history, and I was going to take micro and macro, and I went in with my card, and Harold Freeman sat back. He was white hair. He was kind of cool. He was a statistician. He said, you take that, you're going to be so bored you'll leave by the end of the term. He says, why don't you go over and take Paul Samuelson's mathematical economics course? So I said, okay, and that's how I got into this course to begin with. And I learned my economics backwards because I learned the foundations first, and I took Bob Bishop's micro with all the charts. And but that's how I found out, and I did a growth model. Actually, not my first published paper because it was published later, but my first economics paper was done in Paul's class, and it was a growth model with endogenous population growth. It was in your class. So I was interested in intertemporal optimization from a mathematical point of view, and it seemed like an interesting thing. Then when we got involved, and I found out warrant and convertible bond pricing was okay too, then I got involved in the uncertainty. So you see, so then I thought, wouldn't it be neat if you could combine uncertainty with intertemporal optimization? But the only techniques that I had ever learned anything about were the calculus of variations and then the maximum principle. And so I really didn't know how to do it. So I started exploring to find ways to do it. When I was a graduate student, finance was not in the mainstream of academic economic research. And if I can locate for you, I was a graduate student in the economics department. No course taught in the economics department taught the Modigliani-Miller theorem, even though Modigliani was here. The mean variance model was taught as a simple example because it was its validity was not consistent with expected utility theory and so forth. And so just to locate it for you, that's the degree of separation from it. So when I did my continuous trading model, what I was imposing on the model was the idea that the length of time between trades was short. But it turned out that under the sort of prototypical type processes where the distributions of returns remain the same each period and sample paths were continuous and a few other things, but standard prototype things, that led you to portfolio rules which were identical to the mean variance. One of the contributions I thought was that it reconciled what was a very neat theory that everybody wanted to use, but where from an academic rigorous point of view, was not being used within economics because it was felt that the assumptions under which it was held were totally inconsistent with reality. Not just special cases, they were just not reality. They couldn't happen. You can't have negative prices, and you can't have, if your distributions can be big enough, you can't have quadratic without having truncations and so forth. So I thought that was one piece that reconciled that, and that was in there. And then from that, it allowed me to look at richer models in which you got insights that were about behavior that would never show up in a single period model. And they came out of that, and that was also in this paper. I had been doing work in parallel on capital structure, on pricing warrants and convertibles and so forth. And then when we came to the option pricing model that Fischer, Black, and Myron Scholes were working on, when, as I mentioned earlier, having gone through all the interview process for economics departments, and gone through all the work of the interviews and even getting a couple of job offers, at the end Franco came in and said, would you like to have a job here? and things were going very well here. I liked it here, and so I had to go meet all the faculty members, and one of them was this relatively recent assistant professor appointment of Myron Scholes. And after I took the offer and joined, I got spent time with Myron, and in the interim before actually officially joining but accepting the job, we talked about a number of things, and eventually found out that the area that he was working on in the area of option pricing and what I had been working on, we shared that. They showed me what they had done, which was to take a dynamic strategy at trading, and at each point in time take a position in the stock in such a fashion to offset the beta or systematic risk of the option through the stock, so as to create a portfolio with zero beta. And once you have that, we all know from the equilibrium theory, the expected returns equal to risk-free rate, and then you close the model. And this was actually a fairly, Myron and others, Mike Jensen and Fischer, a number of people had devised this kind of approach empirically to setting up zero beta portfolios. So the thinking about it in that way was I guess that's part of, I never was quite sure who contributed which to between Myron and Fischer Black on that, but maybe it doesn't really matter. But together, that's how they did it. And so when I went to look at it, I, of course, looked at it in the context of the models that I've been doing. So I did a continuous version of it. And when I did that, what happened is I showed in the limit that when you actually did it continuously, it wasn't just that the systematic risk disappeared, but all the risk disappeared. And then it was pretty clear from that that meant that there was a dynamic trading strategy that could literally replicate the exact payoff. So you could find a dynamic strategy that when you followed it, not an expectation, but the actual realization would be identical. When Fischer and Myron published their paper, they put both forms of the derivation in their paper. Fischer told me, and I think it's in public press, up to the end of his life, he died in 1995, that of the two, he preferred the capital asset pricing model version because he felt the continuous trading wasn't really, wasn't feasible. You could understand maybe it's just protection. But I thought the other one was more interesting way to do it. Once you sort of saw the problem and looked at this thing, it was it came pretty quickly that the structure of other securities, whether they're convertible bonds, bonds that might default, the corporate bonds, bonds with warrants attached, any of these sorts of things, that they all come from, could be analyzed in the same way. And so one of the implications of this was that you could come up with a unified theory for the pricing of the capital structure of a firm, the right side. And to put it in context, if you go back and look at the textbooks they taught finance in prior to that, so to locate where things were, there was a chapter on pricing equities, a chapter on preferred stock, a chapter on debt, and none of them seemed to have any relation to one another. They were, it was kind of adding up the pieces. The firm, you almost added up the pieces, rather than recognizing that all the claims on the right side are against the same set of assets, and that they're linked to one another, and so they're all contingent. So that element, which you could certainly, if you're giving credit for, I mean, you certainly would say Merton Miller's work was fundamentally recognizing that, and then Fischer and Myron Scholes also were doing the same thing. So it's, we were all kind of doing all this together. Paul had done the work on the American option and shown that it would be early exercise. We then in our joint paper showed for the models we were using, which were utility-based, so at least they were potential equilibrium models. Paul's original paper, as he would be the first to say, was just a positive normative model, which just said that the means are constants, didn't derive them from any equilibrium theory. And we showed in our work with utility-based pricing, which was consistent with equilibrium pricing, that you wouldn't exercise early unless a call unless there were dividends. So we had done that there. Paul had done early exercise as a mechanical. I mean, what I'm saying is just as a result of the math that if you have two different means on the warrant and the stock, you'll get early exercise. So he was the first to really explicitly, I think, work out the valuation. I think where I did on the early exercise was to show that it came from, in essence, whoever the selector was, whoever had the choice of exercising the option, you would look at the answer, the pattern which would maximize the value. Because otherwise, if it was any other pattern and gave a lower value, if you sold at that price, all I have to do is turn around and say, aha, I was thinking something different, and change the price. So the only possible equilibrium was that. So I did a bit of work on that too, but Paul's work was the first on that. Myron and I I guess, probably the first time was in 1971, went to Wall Street with the Black-Scholes model. The bad news was that two guys showing up in their 20s talking about partial differential equations and stochastic processes and etc. was not something that caught the attention of a lot of people. Today, it's of course very different. You at least can get a hearing from somebody and they don't throw you out. But at that time, it was totally off the wall. And one concrete example of where being involved in practice, even early in my career, really helped my research was they came to me one day, or came to Myron and me one day, and they said, we're doing a lot of trading of an option in Hong Kong that we aren't quite sure how to value it or what to do with it. There's a thing called a down and out option, which was like a call option, but if the stock price fell below a certain level, it was canceled. So you're down and you're out. All right? And I said, well, how do you do that? And the way the option pricing model was derived, it was very clear that you could take any derivative, what we now call derivatives, any security whose price depends on some other security's price, and you could essentially replicate its payoffs by some dynamic strategy, and that all you had to do was be able to characterize what the boundary conditions were that characterized the security. So I sort of scratched our head and said, oh, this looks like a very difficult problem. And of course, all it meant was we just had to put the right boundary conditions in. So it's like having someone giving you a secret sauce or something that allows you, it's like a Lego set or something that you can, whatever the analogy is, you can build. And so we solved the down and out problem and came back with them and said, this is. Now, later on when I wrote my paper on option pricing, this laundry list long thing, I was trying to illustrate how you could use the technology for a lot of different things. So I put a lot of different, and one of the things I put in there was the down and out option. Now it turned out later on there's a whole industry called exotic options that's evolved, of which the down and out is thought of being the prototype. I never would have even been aware of its existence, let alone been able to solve the problem and write it up if I hadn't been involved in practice. If you imagine you have an asset that's not traded, and you say, all right, can I build traded securities? The best asset, the one that comes closest to producing the same returns as this asset. Okay, so you're assigned, it's called a tracking portfolio technically, but just say, could I build a portfolio? What's the best portfolio I could build out of traded securities to replicate or come as close to replicating this? If you could perfectly replicate it, then you're done. And what's best mean, well, you could think of managers as having minimum tracking error, minimum residual variation between the portfolio and the target. If you do that, and you used all traded securities to do that, what's going to be the outcome of that tracking error? It's the same thing you find from regression theory, that the residual or the tracking error between the traded and the non-trading thing has to be uncorrelated with all traded assets. In any real-world economy, I mean, well-developed financial economy, if I have an instrument whose returns are uncorrelated with every traded asset, I mean, just think about that for a minute. That's pretty idiosyncratic risk. It's probably hard to imagine that being priced, that has an expected return of other than the risk-free rate. And there's, call it diversifiable, whatever you want to do it, but just thinking about it. And if you buy that, then you can close the model, because you can say, I'll build the best tracking portfolio. I will have residual. It will no longer be an exact replication, therefore you have some error. But that error is uncorrelated with everything. So in a sense, it's going back to the Black-Scholes version of the CAPM, where they took out the systematic risk, but you're now taking out everything. You're taking, you're just taking everything that you can get with a traded security. So it's even more than systematic risk factors. It's everything out there. So it seems to me that allows you to price it. And what you would now do in today's world is package up that residual risk and find places to place that risk where people will pay the highest price for it, will require the lowest return. And those would typically be insurance entities or entities that are used to dealing with actuarial risks that are very like this, or some kinds of specialized hedge funds that are always looking for uncorrelated risks. What the point of the matter is that it seems to me that the idea, the fact that it isn't traded, somehow makes the model not particularly valid. I think it's, my judgment is far too harsh. It seems to have kept its legs. In other words, it's 30 years later, it's still able to address a richer set of problems. You know, if you raise the ante on what you're looking for in terms of modeling, it allows you to do it. It's more complex, more computationally complex. You may not have all the data, but it has answers. And I think that's been a feature of it that is pretty important. About 5:45 in the morning, the phone rang. And my first reaction was to say, oh, if it's anything, they'll leave a message when I get to New York, I'll pick it up. But then I said, oh no, I'll pick it up and just say, sorry, I'm running to a plane, call me later. Well, I picked it up, and when they identified, yes, it was me, then they said, we have some interesting news for you. And needless to say, I never got out to the airport. It was very interesting because it was the head of the Nobel Foundation who actually delivered the news and so forth. At the end of all that formality, he then put the chairman of the economics selection committee on, who was somebody I knew, to verify that this wasn't a hoax. So I even changed, put on a proper suit, and went down, and there was the world. So it was very nice. It takes a little while to sink in, and just to be considered is a great honor. And the idea of actually winning it's just nothing to compare to. Paul Samuelson said to me on the day that I received the news, he said, they're not only going to think that you know every answer to economics problems, but it doesn't stop there. They ask you medical, and they say, they give you everything. So I think they sometimes confuse the prize with this Leonardo da Vinci Renaissance Man or Woman prize, but it's really for a very specific thing. And in my case, it was for evaluation models for derivatives. The world's a very complex place, and we need all the good tools we can. And what I think, the theory that I've written down, which is, I think at the end of the day, the neoclassical model will explain asset prices and risk distributions. Not every day, not in the short run, but sort of unconditionally, I think that will do a good job. Common sense tells you that it would be a remarkable result that the behavior of asset prices in a world where all choices of stock investments are done directly by individuals versus a world where all stocks are selected by institutional managers operating in groups and that individuals are only indirectly investing. Because the behavior of individuals is different than group or institutional behavior. Not because the group or institutional behavior also isn't flawed, but the idea that there's an invariance principle that if you organize yourself as institutions, that the behavioral aberrations will be identical than as you had individuals behaving. It's just, it's possible, I suppose, but that would be a great theorem, and a theorem I don't think that can be proved. If you accept that, then the structure of the way people are doing tests by mechanically trying to mirror the tests that were done with the neoclassical model are flawed. But that's not a reason to throw it away. It's rather to say, I think precisely because the institutions matter, that if these behavioral phenomena, let's posit that they exist and that they're important, that I think they'll be important telling us why we have the institutions we do, not why asset prices are that way. A lot of people like to play, and if they want to play in the stock market on the internet, that's their decision. But for their serious decisions, retirement decisions, savings decisions, tuition, so I think that most people don't want to do that. The idea of people doing all this on computers themselves, that institutional solutions in which they essentially, as you do with your medical and so many other things, that the best thing is to invest, get good advice from good institutional integrated solutions. Look for solutions, not rates of return. You're going to see the creation of integrated solutions, which are all sold on the basis of not things like rates of return, but on performance of they do things. You pay this amount of money, your tuition for your children is taken care of in 18 years, forget it. You pay this amount of money or save this amount for this number of years, you will receive enough money in retirement to sustain your standard of living that you enjoyed in the latter part of your work life. That's what you care about. In the classic Markowitz, you have the risk and return, and your preference function tells you where, and you don't even have to know your preference function. You can kind of do introspection and say, well, I can live with this amount of risk for this return versus this point. But how much do you weight shift your portfolio towards, let's say, longer-term bonds to hedge yourself against unanticipated change in interest rates, or hedge yourself against the shifts in the risk-return slope? That's less intuitive. For those who have technological advantages in the business, I'm talking about producers, I think that complexity is a good news, because it's a barrier to entry. It's a way of building a franchise, so that you should embrace complexity, not view it as something negative. And finally, to the people who are thinking of finance as a career, I think it's just, it's a wonderful, exciting opportunity. I really believe there's a chance to do well financially by doing good, which is to do things that matter and have exciting problems. And while we have wars and depressions and recessions that slow things down, if you look at it from a longer horizon, it's absolutely clear that all the developing nations, and if you include China's emerging market, have to redo their financial systems. It's also clear that the second largest economy by some measure in the world, Japan, a very old economy, has to completely redo its system. It's also clear that while we have monetary union in Europe, we don't have institutional union, so that's all got to be redone. So in terms of total need, and this isn't going to happen in 2 years or 5, so the need's out there. Now, the next thing that's exciting is that there's something you can do about it. You've got all this technology. I'm talking about swaps, derivatives, all these contracts, SPVs, all these models, everything that they're all market proven. There's 270 trillion notional amount of derivatives in the world. So the idea, are we going to have derivatives or not, seems to be no longer a question. It's a reality. It's a little bit like what we saw with a phone system. If you were going to build a phone system today, as people do in countries that need them, you wouldn't look at the United States and say, well, that's a great phone system. Let's put some telephone poles up. Why? Because it was a great phone system when it was built. It isn't worth tearing it down. But if you were building a new one, you wouldn't build it that way. You'd build it as a digital system. And that's the way it's done. Just so in finance. If you're going to rebuild a financial system, you don't look in the rearview mirror of how it was done, even best practice, but rather say, how would you do it using existing technology? So again, repeat, I believe long-term there's huge need. Second, there's huge technology to do something to meet that need. It doesn't get much better now.